Drop a like and do share. Leave your comments and do not forget to subscribe for more videos.
What's up, guys? This is Manoj Shoptani. I welcome you all on behalf of the Edupedia world. It's been a fantastic morning outside, and I'm sure that you guys must be enjoying your life, your surroundings, or each and every environment wherein you dwell in to the fullest. Like as usual, guys. Perfect. So, did you guys miss me up over here? Because it's been long time that we have made and prepared some of the presentations for strategic financial management. So our team was most likely busy with two of the following subjects, law and audit. You guys must have seen a few of my videos over there as well. So I was teaching people about law and audit as well. So if in case you have missed out on those videos, definitely go and watch out them as well. If in case you really want to have that kind of knowledge regarding your subjects relating to law and audit, Edupedia is one such platform which is actually helping the students in its immense manner. So do ensure that you don't miss out to those videos as well. So let's mark the beginning with and let's create that kind of ambience let's create that kind of surrounding for you guys to enjoy and welcome us back with bang as far as the videos relating to SFM is concerned, strategic financial management. So with this today's presentation, I'm going to mark the beginning of one of the most relevant chapters relating to capital budgeting. So most likely, if you can see the past trends of the examination, 12 marks question is normally the usual one. That's the weightage of this particular chapter. 12 marks paper usually come out of capital busting and leasing decisions. Both these chapters basically go hand in hand together. So once I'll be like completing this particular chapter relating to capital busting, I'll mark and move forward with leasing decisions as well. So all you need to do is just interact your mind and do ensure one thing, that whatever I'm teaching you over here, you need to revise that, because that is something which is extremely important for you guys to understand. Perfect, guys. Shall we start? Fasten up your seatbelts. We are about to take over the first topic of the day, and that will be. So, guys, first thing is always first. Let's understand what does capital busting actually mean. Okay, we are going to study about this chapter and for a pretty long time. So, at the initial phase, we need to understand why we are studying it. Okay, and what's the relevance of capital busting if I talk about something related to the entire finance domain. So, guys, in each and every kind of bigger company, have you seen like you take care of your smaller CA firms, or you take care of your like multi millionaire, billionaire kind of dollar companies? If I talk about the construction companies, they all have budgets. In fact, you go in your home, okay, ask your mom and dad, and they'll tell you that they usually prepare monthly budgets in order to ensure that what kind of amount do they need in order to survive in today's competitive arena, today's competitive environment. And they let you know that okay, we have fixed up this particular amount for our expenses, and we need to make savings about for this amount so that we can go ahead and grow in our respective lives. Budget is not just important for the companies. Budgets is something which is basically made for individuals as well. Okay, this is which is something which is very common. Now, this was about budget. Okay, now if I have something in my mind and I am planning to invest a huge amount of money, huge, I mean, I need to have a budget for that as well. Absolutely, I need to have that. If in case I'll be investing a huge chunk of money, a huge capital in that, and this budget is gonna be called as the capital budget for that. So capital budgeting is basically something wherein there is a company and they have like already planned that they need to invest somewhere down the line with another company, or they need to purchase something out there in the market, and they know that it basically involves a huge amount of money, and there will be a lot amount of potential expenses and investments which are large in nature, which is going to happen. So this entire process wherein I'll be making the budget right from the beginning till the end of while attaining that property or attaining that equipment, this complete process is going to be told as capital budgeting. So to summarize it, I can simply make you understand with this that capital budgeting is basically the process in which a business basically determines and evaluates what kind of potential expenses and investments will be required that are large in nature. So wherein you can move forward with that. It is a process of making that investment decision in fixed assets or capital expenditure. For example, building a new plant, it requires capital budgeting. If in case you want to invest in some kind of long-term venture, again, that involves capital budgeting to be done. So during the entire segments or the forthcoming presentations, we'll be focusing on this particular chapter and this particular topic, that is capital budgeting. Capital budgeting, basically, I am basically laying that kind of foundation for you in order to make you understand this thing. So theory portion will be like very, very, very minimal. Okay, maybe like this presentation and at the most the next one. That's it. Post that, I'll make you concentrate only on the examination questions, because this is something which is very relevant for you guys to understand, that we are not meeting and we are not making you understand something with the normal arena kind of stuff. Okay, our main focus and the main goal and the main prerogative is to ensure that you guys clear your C final examinations. Though my another secondary objective will always remain that I need to give my 100% in order to ensure that no stone remains unturned while I provide you the guidance in any of the finance domain area. So that's my job. I'll make sure that you guys get the complete understanding for that. All you need to do is just hold my hand and proceed and move forward in your life. And accordingly, just do revise and retain the topics, whichever I'm telling you. So, are we guys good to go? Perfect. Let's go ahead with the next topic, and that will be project report. Now, the first thing that comes into the mind while you're going for any kind of capital budgeting decision, it begins with the analysis of the project report. Go with any kind of bigger kind of construction company and they'll let you know, okay, that we are going to spend this much amount on this much amount on this, we'll get the raw material like this, we'll have to take care of the location like this, we need to take care of the water fuel like this. What all is that? It is basically the kind of a project report. Okay, what all amount will be invested in what all areas, how much can we save on this particular front, all these things will be like forming the part of project report. And to ensure and make you understand this thing, guys, in the bigger kind of companies, project report is something which is extremely, extremely crucial. Okay. Now, guys, let's understand what all will be included in this particular project report. Okay, to a basic level wherein I'll be able to tell you up. Okay, these particular things are like immensely required in any of the project report. Number one, that project report needs to have something relating to the industry. Absolutely. The beginning for any of the project report will mark will with this information about the industry in any case. Okay, what kind of industry is there in which that particular company is working? That's the number one thing. Okay, and the kind of status we have in the economy. If I'll talk about the kind of, what about the GDPs with respect to that particular production company? How about it's been like reflecting its importance? How it's been like forming a part of that the gross domestic product for our economy and the nation. All this will be like projected in that project report in any case. Number two, what kind of raw material do they require? What kind of products, what kind of byproducts are they like really preparing? This needs to be taken care of. The production process, how it goes on, what all are the plants and where are their locations, their advantages, how about the jurisdictions if the plant is working out in Orissa, how it's is it different if I'll talk about the jurisdiction with Andhra Pradesh. So what all benefits are you like having if in case you set up that project in uh, Odisha rather than setting up in Andhra Pradesh. So you'll get to know, okay, that we need to pay this much amount to the state government as a taxes, octroi, and so many things accordingly. How about the water, power, fuel? Are we setting up the project in some village area or are we setting up the project in some city? Because if in case we are setting up the project in city, definitely it's going to be very much good if I'll talk about the convenience part. But it's going to cost me much. Okay, because city is working with a competitive arena and environment, definitely you'll have to shed more bucks over there. But if in case you'll be like setting up your plant in some of like villages, definitely you can get the best of the advantages for village area as well, because the land will cost you immensely less and inexpensive over there. So all these things will be like reflected in your project report about your cost of production, your cost of project, how about your capital structure, from where you are going to take out the money for your financing, how about the profitability for the next 5 years, what all are your projections, what all could be your cash flow statement, all these things. I'm just telling you the brief part, though it's huge for you guys, but you need to understand this thing. All these things will form part of the project report. And believe me, this project report, guys, it's extremely advantageous for any of the organization to prepare the project report. Why? Number one, you'll get to know about the objective, why you are preparing that business, and why you are investing in that particular business in any of your sphere. Number one. Number two, you'll get those objectives straightened up in a right perspective. Okay, that I need to move in this direction because I've already made this project report and I need to figure it out how I can be able to like reach to my destination by via this medium of this project report. Number three, if in case you will find any other constraint on getting the resources done, maybe your manpower, your equipment, or something, so you can prepare yourself in order to take those remedial actions anytime soon. Okay, I have the fallback option to, I've got the option to fall back upon and any of the other things, alternatives. Accordingly, I'll line up things. Next, it also makes and paves the way for the management to seek the financial accommodation from the financial institutions and banks. You can go for the bank and you can ask them, okay, I've prepared this project report and I'm gonna set up this project in Odisha. Will you be able to provide me the loan for that? Absolutely. The bank is gonna help you up if in case you've already prepared your project report and the kind of profitability you'll be like showing in that project. If in case your bank statements and your balance sheet is good enough, definitely they're going to give you the loan as well. So this is how these are the advantages of forming the project report. You'll be able to take up the loan, you'll get the objectives done, you'll be like moving in the right perspective. You can have the fallback option upon any time. Alternatives are always prepared, and the successful implementation of a project basically depends on the line of action that you'll be going through, and this project report is going to help you up in forming that line of action anytime soon. I hope I was able to make you clear why project report is important for any of the capital budgeting decision. And I hope you got that. Perfect. Let's move towards the next topic, and that will be bridge finance. Now, I want to give a very good example to you in order to make you understand this thing. What's bridge finance actually mean? Okay, supposedly you wake up tomorrow, okay, and you don't have a penny in your pocket, okay, and you just go to your mom and you ask her up, mom, will you be able to provide me $100? She'll say, you have got your ATM card. Why don't you just go to the ATM and get the money out? You'll say, mom, I need some money in order to reach to ATM first. Okay, kindly provide me that 100 rupees. I'll go to the ATM. I'll get 1000 from there. I'll pay you back your 100. This is exactly what's going to happen in bridge finance as well. This is a very good and a very cute example that I'm telling you of. Okay, now if I'll be like telling you something relating to the bridge finance as far as the construction companies and the capital busting aspect is available. Supposedly you have applied for a bigger loan, let's suppose 100 crores, okay, for IDBI bank or HDFC or any of the banks, okay, but it takes time for the bank to approve and sanction that loan. Obviously it takes time, but you require the funds now. You already started your production and you require a small amount of fund in order to at least begin the activities. Absolutely, you require them. So what's going to happen is you'll ask another bank, okay, another company, another commercial company to provide you a finance for a short period of time in order to ensure that while you get the major loan amount from the bigger bank, that sanction amount, at least you can start out your daily activities and routine jobs. Meanwhile, while you'll be like receiving that higher amount, that bigger amount from that bank, you'll be able to settle it down and you'll be able to repay for that small amount of loan that you have already received from another company. Bridge finance is that activity. Bridge finance basically refers to the loans which are taken by a company from commercial banks for a short period, pending disbursement of the loans which are sanctioned by financial institutions and banks. So what's going to happen is once you'll be like receiving the bigger amount from that company, that bigger bank, you'll first repay your term loan which you have like just taken for a short period. You'll be able to repay as and when you'll get the disbursement from your concerned institution. Bridge finance loans are repaid out of the term loans as and when disbursed by the concerned institutions. Bridge finance are generally secured by hypothecation of the movable assets. Usually, what's going to happen is that small bank is going to ask you, okay, kindly hypothecate your inventory. Okay, if in case you will not be able to repay us that particular loan amount, at least we have your inventory, okay, to fall back upon any time, and your loan will be secured by that hypothecation of your movable assets. That is your inventory, maybe your debtors, your personal guarantees, and your demand promissory notes. This is something which is very common in any of the cases. And generally, what's going to happen is the return rate of interest basically on bridge loans are usually higher if I compare it with the term loans. Term loan is going to be like for like 5 years, 10 years, 15 years down the line. But if you require money on short notice, will you pay Higher amount of interest to them or lower? Absolutely higher. You require them a short notice, short period of time, definitely they're gonna charge you up a higher amount of rate of interest in comparison with the term loans. So this was all about bridge finance, and I hope I was able to tell you up clearly what kind of understanding you can develop if in case you are working with the concept of bridge finance. Shall we proceed further, guys? Let's move ahead with the last topic of the day, and that will be refinancing. So now, again, this is a very relevant concept. You'll come across this situation while practicing your questions as well. The kind of questions that are usually asked in CA final examinations. Refinancing is one such topic wherein this important element basically gets inserted, and it's there in the questions as well. So guys, refinancing, what usually happens in refinancing is you go to a bank, okay, you just went in IDBI bank and asked them then, okay, IDBI, I require a loan funding for let's say 100 crores, okay. IDBI said, okay, we'll be charging you something on floating rate basis, okay. So what's going to happen in floating rate is the kind of rate which is going on in the market that will be like floating accordingly, that will get changed. Your rate of interest will not be static, your interest will not be fixed, so it will change according to the guidelines and the kind of news which is going on in the market with respect to the floating rate of interest. Accordingly they'll charge you. Sometimes they're going to charge you like 12%, sometimes they're going to charge you like 14%, then 16%. So you'll say, okay, I'm done with it, I'm cool, no worries. Now what's going to happen is someday later on, okay, let's supposedly think about a situation wherein you get to know that the interest rates are going to rise, okay, and you are aware of this fact, okay. Maybe something is going on into the economy, maybe something is going on in your industry wherein you're pretty much sure about this fact that the interest amount is going to increase, okay, and since you have already booked up that loan on floating interest rate basis, definitely you'll have to shed more money now in order to ensure that you repay for that interest. What's going to happen in your mind is you think about like a bigger company, the bigger construction, bigger giant company. It's going to cost you much. So what's going to happen in refinancing is you'll be going to the same bank, okay, the IDBI bank, and you'll ask them up, okay, IDBI, I earlier made in short that I need to get into an agreement with you for 100 crores at floating interest rate charge. Now, what I'm thinking is why I shouldn't go for an option wherein I can like secure my loan amount with the same assets. The only change will be like I'll be paying you that rate of interest on a fixed basis, okay. Let's mark it as 11% fixed. IDBI will say, okay, cool, fair enough. We'll be like able to do that for you. Then what's going to happen is now since you have changed your rate of interest and you have changed your financing, okay, this particular thing is called as refinancing, wherein you'll be applying for a secured loan intending basically to replace your existing loan. 100 crores for a floating rate of interest, now 100 crores for fixed rate of interest. So what you did basically over here, you basically shifted, you replaced your existing loan amount with the same amount of loan. No change in that. The only change will be your interest, rate of interest, okay. In my example, okay. So this particular stuff which I told you of, this is basically classified into the category of refinancing, wherein you'll be applying for a secured loan intending to replace an existing loan which is already secured by the same amount of assets. Now, getting into the purpose. Now, why I will go for refinancing at any time? Number one, in order to reduce the interest cost, that is the major factor for any of the company, because you know that you'll have to shed more amount of money if in case, definitely you'll go for an option wherein you get a better opportunity and you can save your cost for any of your company. Number one is that you'll be able to reduce your interest cost. Number two is if in case you want to pay other debts as well. So what's going to happen in refinancing is you already paid a few of your debts, okay, and now you're already like you earlier financed 100 crores but now you don't require them up, so you'll go for the refinancing option wherein you'll be like asking them for providing you the lower amount of loan and you'll be like able to provide them the other one, okay, or you'll be asking them for providing you the higher amount of loan again. So because you need to pay other debts as well, so you'll ask them kindly provide me 100 crore as well, okay, and I'll be securing that particular loan with the same amount of assets. So if in case the bank basically agrees to your negotiation and your consideration, they'll be able to provide you the loan in that case as well. So number two is to pay off other debts. Next, to reduce one's periodic payment obligations. Now Let's suppose I get into an obligation that I need to pay the interest every year, every month basically. Okay. Now, supposedly, I get an option wherein the company, the bank basically asked me up, okay, dude, you have like, you're shedding your bucks each month. Okay, you're basically paying us the interest each month. Now, if in case I give you an opportunity wherein you can give me the interest like quarterly basis. So what's going to happen is I won't be bearing that kind of burden where I'll have to like pay the banking company each month. So what's going to happen is this will basically going to help me up with reduction in my periodic payment obligations that I need to pay each month. So again, this will be done under the category of refinancing only, wherein they'll give me an option to change my existing loan and replace it accordingly. Then to reduce risk, again, that is the last thing which is gonna happen. Now, I've like taken up the loan amount, okay, and the somehow the risk amount wherein the risk amount which is basically involved in that particular loan obligation is a huge one, okay, and the same kind of loan is available to me with any other insurance this banking company, and they are providing me the same amount of loan with some other kind of instructions or obligations wherein I need to cater them up but in a better way. So what's going to happen is this is going to basically help me up in reducing my risk with my existing loan. So I'm going to replace it with my new loan. So for all these purposes, primarily the first one, that is to reduce the interest cost, refinancing is a very good option, and usually big time giants usually take up this facility each time. So I'm sure you guys got the complete clarity with respect to why we should go for refinancing as well. Now, with this particular topic, this presentation comes to an end. Today we all discussed about the capital busting, refinancing, bridge finance. Do revise these topics because that is something which is extremely important for you guys to understand. With this, I'll see you in the next forthcoming presentations. Till then, thank you on behalf of the Edipedia world. Keep interacting via questions, queries, and YouTube boxes. I will love to solve them up for you guys. If in case you have liked our video, if in case this video was informative to you, definitely do give us a thumbs up. That will act as a moral booster for all of us. Stay connected, guys. I'll see you in the next presentation with a lot more fascinating and exciting topics. Till then, sayonara. God bless you all. Take care. Bye.